Good day everyone, my name is Pieter Hugo, I'm the MD of Prudential Unit Trusts. Today I'll be talking to you about tax-free savings vehicles and try and answer a couple of questions you may have on the subject. The biggest benefit is obviously that there's no tax, in particularly income tax and capital gains tax, dividend withholding tax within this particular vehicle. If you think about it, all your investment returns normally there's some tax that get taken off before you can enjoy the benefits of those returns. In this particular vehicle, there's no tax being taken off, which effectively means your investment returns are boosted. I think it's important to understand both, and I also think there's place for both in every investor's portfolio. Your contributions to a tax-free investment is made from after-tax money. You first pay your tax, then you make contributions into this vehicle. During your investment term or inside this vehicle, there's no income tax being payable or capital gains tax or dividend withholding tax. Investment returns, as you earn them, you can enjoy the benefits thereof. This vehicle is also fully liquid. You can take out your money at any point you would like. Obviously you get an annual contribution limit, and you can't, if you take out money, you can't get that back. We would obviously view these vehicles as long-term investment vehicles, but there is the benefit of liquidity in case of an emergency. So during your investment term, your investment returns doesn't get taxed, and when you take out money from a tax-free investment, those proceeds are also not taxed in the investor's hands. An RA, you typically contribute with pre-tax money. There are certain limits in terms of how much you can contribute to a retirement annuity, but it's from pre-tax money. Within the vehicle or within the retirement annuity fund, there's also no taxes, very similar to a tax-free investment, although there's liquidity constraints on the money. You can't get money out of an RA before age 55. And then when an RA pays out, eventually when you retire, that proceeds are typically taxed at your marginal tax rate at that point in time. You do get the option to take 1/3 in cash, and the other 2/3 must be annuitized, either in a guaranteed type annuity or in a living annuity product. I think the tax-free investments is a fantastic opportunity given to investors by government to save tax-free. I think you can use both a tax-free savings vehicle as well as a RA in your overall investment portfolio, and I do think there's place for both of them in your portfolio. I would think that most clients need to consider how much money they need to contribute to their RA, and then also how much can you contribute to your tax-free investment. There are limits to both. In terms of the tax-free investment, each investor is limited to 33,000 Rand per annum that you can contribute, and the overall lifetime limit currently set at 500,000 Rand. In a RA, you can typically contribute up to 27.5% of your pensionable salary, but there's also a Rand maximum cap on that at 350,000 Rand per annum. I think the one thing that you have to consider when investing in a tax-free investment product is how does this fit into your overall investment portfolio. We typically see investors, when looking at this particular product, just trying to maximize the tax saving. We would argue that investors need to think, how does this fit into my overall portfolio? And then typically, how do you want to maximize your overall investment returns after all fees and tax? So when many clients want to invest in money market or fixed deposit type of investments in this particular product, that's probably very good for maximizing your tax saving, but typically cash investments only yield about 1% real return. That's a return over inflation, and inflation is your biggest obstacle when investing for the long term. So you want to outperform inflation over the long term, otherwise you erode the value of your money. So when clients look at cash investments and you want to save on the tax, while the tax-free investment vehicle offers that to you over a long period of time, you're effectively going to achieve about inflation plus 1%. Other asset classes, growth assets like equities and property, There you can probably achieve inflation plus 6 to 7% over long periods of time, although that obviously comes with volatility. So those asset classes are typically very good also to include in your tax-free investment vehicle, thereby not only maximizing your tax saving, but maximizing your after-tax investment returns. Prudential also offers a tax-free investment vehicle that you can invest directly with Prudential, and within that vehicle we offer a very wide range of funds covering all the major asset classes that you can invest in, ranging from income and balance fund to equity funds and offshore investments. I hope you found this information very useful. If you need any further information, please feel free to contact us or contact your financial advisor and ask them about tax-free investment.